Today we're going to talk about some of the differences between filing Form 1120 and Form 1120H for homeowners associations and condo associations. In addition to that, we're going to touch base on some of the advantages and disadvantages to filing the 1120H form itself. Now, as a CPA firm that does tax returns for HOAs in all 50 states, I would say at least 90% of the HOAs that we deal with file the simpler Form 1120H. Okay, this is an easy form to file, relatively straightforward. In fact, we find that the state filings can be a lot more complex than the federal filing under 528. But it is an important area for us to touch base on. What are the differences? What are the pros and cons? And what should your association be considering when it comes time to file your actual tax return at the end of the year? I'm going to take a look now at some of the advantages to Form 1120H. First of all, 1120H is audited substantially less than Form 1120. In fact, you become sort of a small fish in a big pond with 1120H, and most of your income is not taxable, so you're going to subject yourself to much lower audit risk. Number two, the exempt function income of the HOA is not taxable, so a large portion of the income would not be subject to tax, which is not the case under Form 1120. However, any excess non-exempt income is going to be subject to tax and at a slightly higher rate, so that's one disadvantage. Number three, the tax form itself is relatively straightforward and much easier to complete than Form 1120. Number four, certain states exempt associations that file 1120H from state income taxes, so it certainly can make your state tax returns a lot easier. And also, HOAs are not subject to the alternative minimum tax or AMT that you might find under filing 1120. However, there are a couple big disadvantages of filing 1120H. There's three main disadvantages. Number one, any taxable income of the HOA would be taxed at 30%, and this would be in contrast to an 1120 that is subject to only 50% of the first $50,000 of net income. Number two, another big part is that HOAs are not able to claim a net operating loss. So if there's a year where there's extensive expenses, they're not able to claim that loss and carry it forward into the future. The third biggest disadvantage of filing an 1120H is the fact that a lot of tax practitioners just aren't familiar with them. You'll find a lot of CPAs and tax professionals just aren't familiar with HOA tax returns. They may be a lot more familiar with 1120. So even though it's a simpler form, it may be a little bit more confusing for the tax professional. So hopefully you understand a little bit about some of the advantages and disadvantages to filing 1120H. Again, the vast majority of associations are going to want to file this form because it's simpler, easier, less subject to audit risk. But certainly you have to qualify under Section 528 in order to do so. Again, if there's major net operating losses or other considerations, it might make sense to file 1120. The advantage though is you can do the tax return under both scenarios and file the return that's most advantageous to the organization.